Brunch and Learn. We've got the Pledge of Allegiance now, and we'll start with our program very shortly. Good morning again, everybody. This is Jonathan Wyant with the Affiliate Committee. Happy to have everybody here today for April already, April's Brunch and Learn. We've got Ruth Benjamin here with creative tax strategies to help all of you understand and your customers how to defer capital gains taxes. Ruth, go ahead and take it away.
All right, Jonathan, thank you. I want to thank everybody for being here today. And I am currently seeing, oh, there we go. Now I can see everybody. Okay, so I want to introduce to you these very wonderful professionals that joined us today to talk to you about how to guide your clients when it comes to deferring capital gains taxes. So I am going to jump right in. As you know, Scott Barney is my business partner, and so he will jump in here with us. He's the one who created these questions, and I have just stepped in. So we are going to go ahead and get started, and I'm going to ask each one of you to introduce yourself, and then your first question, you're going to have 3 minutes to answer. What tax deferral strategy do you represent, and how does it benefit the seller or investor? So we will go ahead and start with Michael. Michael is our 1031 person, so he will be the person that you will address any 1031 exchange questions to. So Michael, go ahead.
Wonderful. Thank you very much, Ruth. Thank you, Scott. My name is Mike Casada. I am with Old Republic Exchange. I am a sales executive here in the San Francisco and South Bay areas. And at Old Republic Exchange, we are a qualified intermediary that provides the facilitation of the relinquishment and acquisition of real property through the 1031 exchange tax deferral strategy. So as a qualified intermediary, we hold the exchange proceeds for the exchanger during the process, ensuring that the exchanger is never in receipt of the funds. A 1031 exchange utilizes the IRC section 1031, which provides an exception and allows for the deferral of paying tax on property gains, both on the federal and state level. This allows a seller and investor to sell an investment property and to purchase a replacement investment property within 180 days. There are 4 methods of exchanging: a simultaneous exchange, a delayed exchange, a reverse exchange, and a construction or improvement exchange. The primary benefit of utilizing a 1031 exchange is the deferment of taxes on capital gains. But another major benefit to sellers and investors is also the ability to leverage that money owed to the IRS by reinvesting it in their replacement property, empowering them to make a larger down payment, qualify for a larger loan, and to purchase a more expensive property. By doing so, they're able to purchase a property with a larger cash flow, a higher rate of appreciation, or in a better location. There are many different types of properties a seller and an investor may include in an exchange. You can exchange a residential property for residential property, a residential property for a commercial, or even vacant land for a property with improvements, as long as the exchange is for real property that is of like kind. Like kind meaning real property that is held for investment in exchange for real property that is also held for investment. This deferment strategy allows someone who may own land to now exchange into an income producing property, or perhaps a landlord who is over dealing with tenants and property management to exchange for a property without those same headaches. Just keep in mind that this strategy is specific to investment properties only. Primary residences and second homes are excluded from performing a 1031 exchange.
All right, well, thank you. And I know that most of you real estate agents are familiar with 1031 exchanges, and Michael, that was great to go ahead and cover that. So if anybody has any 1031 exchange questions, please address them to Michael. So let's go to Peter. Peter is our Delaware Statutory Trust person. Peter's located here in San Francisco. So Peter, go ahead and introduce yourself and tell us which strategy, which I already said it, but how it benefits your clients.
Great, thank you, Ruth. Good morning, everybody. My name is Peter Fisher. I am a wealth manager located in San Francisco. My company is Sequent Real Estate and Wealth Management. They're real estate first financial advisors. Many of our clients come to us with 1031 exchange needs, and we utilize a replacement property strategy known as the Delaware Statutory Trust, or DST. The DST is a multiple owner real estate investment strategy that allows for 1031 exchange dollars. So it is like kind real estate. The typical DST is a large institutional investment grade asset, such as a 200 or 300 unit multifamily property. These properties are typically located all throughout the United States. You're not going to find them located in California for the most part. So we work with a lot of investors. If you can imagine, think about your clients. There's a generation of individuals today that are selling investment property, and they no longer want to be involved with the day-to-day management. And of course, capital gains tax is their #1 issue. So we are providing the opportunity for these individuals to exit the real estate space and sail off into the sunset, if you will, by not being landlords anymore and deferring capital gains tax, investing in passive real estate strategies. So again, many of our investors are of the generation that you can imagine are the baby boomers looking to get out of the day-to-day management.
All right. So I know that with the 1031 exchanges, the Delaware Statutory Trust is a great option when clients cannot find real estate and they are running into multiple offers. So keep Peter in mind when you have a client that's in the middle of an exchange and he's close to that 45th day and he's panicking. Get him connected with Peter because he can help with that. So the next person I want to introduce, with really she needs no introduction, but Anita Steberg. She is on the affiliate committee. She's a big part of SCORE. She is your go-to person for any of these tax strategies that are being talked about today. She gets in there and fights the IRS for you. So you want to know Anita, you want to know her phone number, put her on your speed dial. So Anita, go ahead and you can introduce yourself again, but tell us about the strategy you're talking about today.
Sure. So Ruth, thank you for the kind words. So I'm Anita Steberg. I am with Steberg Law Firm. I'm the founder and CEO, which is in San Jose, California. And something that is different about my perspective is I'm an attorney. Peter is part of, he helps people with DSTs. Michael helps people with 1031s, and they do them as an intermediary. I come from it from a law perspective, and so I may have a different perspective because I'm not involved in any of the transactions, but I'm very familiar with MIS, monetization installment sales, because I defend them in audit. I do legal opinion letters on them. I help clients understand what exactly they're getting into, for better or worse. The clients can always choose to do the strategy, but I want to make sure that they understand what exactly they are getting into. So a monetization installment sale can work for, it's not only restricted for commercial property, it can work for second homes, personal property, businesses, as well as commercial property. Stripped down to its barest components, we are dealing with Internal Revenue Code 453. 453 allows an installment sale on a transaction. You can sell it to whomever you want. In this case, for a monetization installment sale, you're selling it to a dealer. In exchange, the taxpayer is getting an installment sale for that property. The dealer will then immediately turn around, because there's no restriction on how long a dealer has to hold the property, and the dealer will sell it to the end buyer. and it will instruct you as the seller to deed it specifically to the end buyer, because otherwise there's no reason for it to go from you to the dealer, for the dealer to the end buyer. It ends going to the end buyer. So we're going to take out a step and just the dealer is going to say, title it back over to the end buyer. There are some restrictions. So the restrictions when you're dealing with any type of installment sale is $5 million per taxpayer per year. If it's above that amount, then we have to get creative with additional tax strategies. And the advantage is potentially a 30-year deferral on the capital gains taxes. So that's one side of it, is the installment sale. The other side of the transaction is through an unrelated party. There you are going to get a loan for the same amount that you would have received if you had sold the property for cash. That is going to come through you to a loan. You're going to have a promissory note, and there is going to be an obligation for the next 30 years. The way that it works is basically the dealer is putting funds into your account so that you have the funds from the installment sale, and that way you can pay the loan. The two contracts will mirror each other. The loan that you receive is restricted to business or investment purposes. At least the initial use, you can't just go throw a party, go on a trip around the world. It is restricted, and there are some legal reasons for that. So I help people understand a complicated strategy, which there is an intermediary, like there is in a 1031, which is the dealer. There is an installment sale, there's a lender. So this one has a lot of moving parts to it.
All right. Well, thank you, Anita. The monetized installment sale is a great strategy for people that just do not want to own real estate anymore. So thank you, Anita, for that. And we will address all of the monetized installment sale questions to Anita. Now we're going to reach out to Scott Varney and Barry Bruce. So Scott, I guess I'm going to let you speak, and then Barry will be here also if there's any questions. So Scott, tell us about your tax deferral strategy and how it works for your sellers or investors.
So for the morning, I am representing Dynasty Spendthrift Trusts. The table talk term for it is non-grantor, irrevocable, complex discretionary spendthrift trust that is not self-settled. I'm sure that's what everybody talks about, right? So it's a pretty complicated name. So we've dumbed it down to Dynasty Spendthrift Trust.
It's another DST.
Another DST. So, which has been kind of interesting when somebody says, I want to talk to you about DST. It's like, oh, what are you talking about? All right. So it's kind of like a Swiss Army knife in terms of you got many tools. So there's many advantages to this type of trust. One, step up in basis. Many of us that are following tax proposals know it's on the table for the step up in basis to be eliminated. Will it happen? We don't know. But in this case, if your assets are in the Dynasty Spendthrift Trust, there is no step up in basis issue. So because the trust, when you pass away, the trust owned the assets before you pass away and after. So there's a tax benefit. So if that is eliminated, you're protected from that. Another one that's on the table, and I read the Tax Foundation, so I love seeing what's on the table, and Anita knows even more of what's on the table on these kind of things than I do. So estate taxes. So a lot of people don't realize that when you pass on your estate, there's a tax of 40%, but you have an exemption right now of 11.58 million. In 2025, that's going to roll back to 5 million and adjusted for inflation, so about 6 million per spouse. But right now on the table is to roll it back to 2009 timeframe of 3.5 million per spouse. So 23 million of estate exemption is going to potentially be dropped to 7 million, and then the tax rate is going to go from 40 to 45%. If your assets are in the trust, you get to actually all these strategies here represent wealth accumulation. But the last thing you want to do is give it all to Uncle Sam. So there's a way to preserve that wealth. And that's one of the other advantages. Then there's the tax mitigation. capital gains taxes, some active income taxes. So there are ways to address those within the trust as well. So standalone, it will address taxes. And that's where you get somebody like Anita involved to for consultations to see what the benefits are using the Uniform Principal and Income Act, as well as IRC 643. All right. And then on top of that, all these other strategies can be done from within the trust.
All right. Okay. Thank you, Scott. Okay. So what Scott's talking about is a trust that will help with all of these tax problems. The key with the trust is you got to be planning. You can't do tax reaction. So any questions that you have regarding the trust will be addressed to Scott or Barry. So let's go to our next question. Michael, we'll go right back to you. Now you have 1 minute to, this is like a competition, right? 1 minute to share one really helpful insight, a tip that a prospective client should know in regards to your tax deferral strategy.
All right, well, I am going to cheat and I'm going to make it quick so I still fit in the 2 minutes and sneak in 2 of them here. So, because really there are 2 key takeaways. The very first one is going to be you have to make sure that the 1031 exchange is set up prior to the close of escrow. It should definitely be a minimum of 24 hours, but as much time as possible makes things as easier on all parties, because we often get calls for an exchange. We start the process and then we find out that escrow closed a week ago, and now that means that the taxpayer has received the funds and no longer qualifies for a 1031 exchange. The second takeaway is make sure that you always work with a vetted and reputable qualified intermediary. The IRS requires that the taxpayer engages in the 1031 exchange through a qualified intermediary, but they are not regulated. So you definitely want to make sure that anyone you are going to be working with on a potential 1031 exchange has a lot of experience and financial security to protect your money. Thank you.
Very good. Yes, that's very important. Know who you're handing your money off to. So make sure they're bonded and insured. And the title company intermediaries are the most strongest ones because they have the backings. So if you're using an independent one, check out, make sure that they're bonded and insured. So thank you, Michael, for that. So Peter, let's go to you. Share your helpful tip for your clients.
Great, thank you, Ruth. So I think that there's 2 major pitfalls to a 1031 exchange that we see. Number 1 is timing. We must identify replacement property by 11:59 p.m. on day 45. And number 2 is you need to replace all of the real estate you sold to defer 100% of your tax. So the Delaware Statutory Trust is useful because this is a property that has already been purchased. So title has already been secured. The financing terms are already set and closed before any investors come in. This means that you can call me on day 45 and I have probably 10 different options for you to exchange into. You can use that as a replacement or as an emergency backup. And the DST is very useful for boot if you don't find enough replacement property as well. So if you sell $1 million property, but you only find $800,000 to replace, we can take that $200,000 incremental amount.
Nice, very good, Peter. All right, Anita, tell us what your helpful tip is on monetized installment sale.
So once again, I'm going to echo Michael and Peter's recommendation, especially for an MIS. This can be a complicated strategy, especially if you are coming out of a 1031 and you cannot find replacement property, or there is maybe you can't find sufficient for whatever reason. So it's because we may have to do some tax planning because maybe you're over the 5 million mark, or perhaps because there's another strategy that you started to take and you wanted to find out if it's something that is an option to save the 1031. Set it up as soon as possible. So because if you do have to do a more complicated strategy, you can't call on day 44 to say, hey, I have a $12 million sell. It's only me is on title of the property and we're closing tomorrow. What can we do? And I'm going to tell you, you're out of time. So start the process early, and that's with any tax strategy, whether it's a 1031, whether it is the Dynasty Spendthrift Trust, whether it is the DST, whether it's an MIS. These strategies need to have some certain steps taken in certain orders. So make sure you have sufficient time.
Very good. I agree. You know, when as a real estate agent, your job is to not give your clients tax advice, right? That's not what you want to do, but you at least have to let them know about the strategies that are out there for them, because the last thing that you want to happen is for them to tell you, why didn't you tell me? So that's why we put this together today. So Scott, we're going to ask you to share your really helpful tip for your clients.
All right, two, and I'm going to go back to what Anita said, tax planning. This strategy is best if you are planning in advance of things. So it's best to open a trust in one tax year and put assets in it and sell your assets in another tax year. So that's best to reduce the chances of audits and all that fun stuff. So tax planning and not tax reaction. And secondly, if you are not aware, about 40% of the LLCs are pierced in court, and your assets could be subject to being lost in a lawsuit. So the trust would actually protect all that wealth you're building. It's ironclad asset protection on top of the tax advantages. So it's like, again, that Swiss Army pocket knife. So find out if you have good asset protection. And my guess is you probably don't have it as good as you think.
Right. Okay, you guys, instead of asking Barry to speak, he sent me a text. If you're looking for a 1-minute topic, first rule of tax planning is don't lose your assets. All right. So make sure you connect with all of these people so you can hold on to your wealth. All right, let's go into the next question. And it's 2-minute answer. You guys have done great staying in the time. Nobody's getting hit with the alarm. So Michael, share a common objection or complaint about your tax strategy that you have to address on occasion.
Absolutely. So obviously we've been sitting here talking about the timing issue, right? One of the big objections that we get is about the 45 days to identify a property, and that is just not enough time for some people. Well, the answer to that is an exchanger actually has the ability to start shopping for their replacement property, start planning what tax strategy they want to utilize, if they want to combine them together, and do that before they ever sell. The 45-day clock starts at midnight the day they close escrow on the relinquished property. So if they start shopping before they close escrow, essentially all those extra days get added on and they have bonus time, unofficially, more time than the 45 days. So definitely want to take advantage of that. The other objection we get, which just came up and is being talked about right now because we had a change in office, is whenever an incoming president comes in, they're always talking about possibly getting rid of 1031 exchange. And can't say for sure what will happen, but we can look at history. And ever since Bush was elected, we've had rumors that the president was going to eliminate 1031. But once they have an opportunity to create a group and do their research and review how 1031 actually affects the economy, they have left it alone. 1031 exchanges have a very large impact on the economy. They entice investors and sellers to not sit on their properties by giving them a method to reinvest their gain into a new property. So it definitely has a very large boost to our economy.
All right. And I agree with Michael. These 1031s, the timelines are crazy. So start looking for your properties before you even sell. It's okay. So Peter, we're going to go to you and we're going to find out what is the objections that you are getting with these clients.
Sure. Thank you, Ruth. So the DST by nature is a passive real estate investment strategy. That means that you do not have any control. You are a small percentage owner of a very large institutional property. So the lack of control is often something that we discuss with potential investors. And I always ask them, the question is, well, what is your intent with your exchange? And why do we do 1031 exchanges? And everybody right now is thinking to defer capital gain. Sure, that is a result of our 1031. But think about individuals that are actually doing 1031 exchanges. What is the reason? Many of them do not want to be involved in that day-to-day ownership of property anymore. So they're selling their investment asset to get out of being a landlord, especially in today's difficult times. So you have to really make that decision to give up control in a passive real estate investment strategy. It is something that's pretty difficult. If you're used to managing real estate for the past 10, 20, or 30 years, it's so hard to get past that point. But the DST really solves a solution for individuals. They're deferring tax, they're getting income, usually in their retirement, and they're not getting the phone calls at 2 in the morning. They're not dealing with attorneys to try to get their tenants out of their property because they're not paying rent or they're doing things that they're not supposed to do. So it's usually a pretty easy issue to overcome with the investors that we deal with is lack of control.
All right. I get calls all the time because, like I said, Scott and I work with all of these strategies. And that what Peter just said is probably the one thing that I hear. They're not used to giving up control, but they want to receive that income. So it is a good option. Anita, what are you hearing as far as objections for the monetized installment sale?
So when the only strategy we're talking about that has been vetted in courts, and we all play with different parts of the Internal Revenue Code in doing all these strategies, but the only one that has been vetted sufficiently in the court, because we've had it around for so long, is the 1031. All the other strategies, there is a level of risk. So generally the objections are, I don't understand how this works, which we explain it in a minute detail how it works. We also want the clients to know, because like I said, it doesn't matter to me if they go forward with it or not. I just want them to make an informed decision, because I'm not an intermediary. I'm not the person who is selling the DST or the monetization installment sale or the Dynasty Spendthrift Trust. So the objections that I hear, we all talk about goal alignment. And anytime you do tax planning strategy, you need to make sure the end result is getting where you want with your goals. So we talk about goal alignment. What are your goals? Why are you doing this? As well as the level of risk that's involved. With the monetization installment sale, we don't have any guidance from the IRS that is binding on the IRS one way or the other. So you are in a gray area. So we talk about where it's been, how long it's been going on, the pros and the cons of the transaction, as well as does this even align with your goals? Because if it doesn't align with your goals, let's talk about some other strategies, or let's talk about what else is on the table. The one thing I do know is that there was the IRS has stated publicly that as far as taxes, and they just, it was earlier this week, I was reading an article on it, that they are losing $1 trillion a year in lost revenue of taxes because IRS does not have enough enforcement, which signals that the IRS will likely being requests for more funds so that they can hire more auditors and more collectors. So we have to look at what the political environment is, like Michael said, because even though we don't like to think that the IRS is political, when you get to the highest levels and the policymakers, they are very political within the IRS.
All right. Okay, guys, I hope you are seeing that if you want to get into something, hire Anita to go over your specific transaction and see if it's going to work for you. Scott, let's go to you, and you give us your helpful insight tip for the clients that might want to use the Dynasty Spendthrift Trust.
So one of the objections that we come across regularly is when we tell them, oh, the Dynasty Spendthrift Trust is $39,000. It's crazy. You know, people look at it and go, that is so expensive, because in this case, you actually have to pay that in advance of doing the strategy. Whereas the other strategies, that's part of the process of the movement of real estate, and it's coming out of different proceeds and whatnot. Here, you actually have to cut a check for that in advance. So what I typically tell them is like, well, compared to a living trust, oh, it's crazy expensive because you're getting living trust done for, let's say, $2,000 or $3,000 or $4,000, depending on the complications of the living trust. But that only helps to prevent you from dealing with probate court. It doesn't provide all the same asset protection or maybe even tax benefits. Now, compared to a charitable trust that you may be required to give 10% of your whatever you put into that trust to charity. So if it's $1 million asset, 100,000 has to go to charity plus the legal fees. Well, all of a sudden, $39,000 is a lot less expensive than the 100,000 or the monetized installment sale, 6.7% of net sales proceeds. $1 million, that's $67,000 compared to 39. So it depends on what you're comparing it to. So with a lot of the tax strategies, it's actually a lot more affordable. The main issue is they actually have to cut a check, and a lot of people are asset rich and cash poor, you know, and so that's where we run into that problem. But that's how I address that. What are you comparing it to when it comes to the cost?
Awesome. And thank you for answering the right question. And I asked you the wrong one. So you answered
it helps that I came up
so
with a question.
I apologize, you guys. I'm trying to read the questions here and I read you the wrong one. So I'm glad you guys are on it. So what we're going to do now is we are going to open up for any questions that anybody has to each one of our panelists. So I am going to see if I'm opening up the chat and I don't see anybody there, or the question and answer box. Okay,
Ruth,
so
Juliana Lee has her hand raised.
oh, I can't even see that. Scott, you're gonna have to control that because I don't see that.
All right, go ahead, Juliana. You can unmute yourself and ask your question.
You're muted, Juliana. We need you to unmute yourself.
Maybe we put her to sleep. I've asked to unmute. All right, go ahead, Juliana.
No, I don't have any questions. Sorry. I'm just waving. I'm doing exercise at the same time. Sorry.
Hi, Juliana.
Okay.
All right.
Okay, hi.
All right,
Yeah.
anybody else? Come on, you guys. I know that there's a lot of questions. You're probably not even certain what to ask. And the main thing is, what strategy do you recommend to your client, right? There's all of these different strategies, but which one's the best fit for your client? So start asking the questions, find out what they have, find out what they want. Contact us at, Financial Tax Strategies, contact All Republic if it's about a 1031 exchange, contact Peter if it's regarding the Delaware Statutory Trust. And always, everybody needs to contact Anita. She doesn't work for any one of these companies. She works for you. So she's going to be the best person to advise you the best way to go. So as I'm talking, did we get questions in? All right, we do have one question. One says, can you share contacts? Of course, we will make sure everybody gets each person's contact information. But the question that came in, is it a charitable trust versus personal trust? So Scott, is it a charitable trust versus personal trust?
So the Dynasty Spendthrift Trust, they have personal trust and business trust. It is not a charitable trust. In a charitable trust, when it is set up, whether it's a charitable lead trust, charitable remainder trust, charitable lead or remainder annuity trust, there has to be a certain percentage of what you put into it has to go to charity. In the Dynasty Spendthrift Trust, you are not required to put anything into charity. It is all for your beneficiaries. So it's a whole different type of trust. I'm not an expert on charitable trust. I'm hardly an expert on Dynasty Spendthrift Trust. But there is a difference there. But the charitable trust a part of the deal there is you put $1 million in, you get certain tax benefits for the donation, and then, but part of it has to go to charity later. So, and that is not related to what the Dynasty Spendthrift Trust does.
All right, so let's let Barry talk. Barry texted me another question here. So Barry, why don't you just unmute yourself and talk about combining these strategies?
Oh, thanks.
We're not getting questions in, so I'd like you to kind of talk about, tell me a little bit about your background, and Barry would be the next person to talk to after Anita. Anita's the attorney, but Barry, go ahead and introduce yourself. Okay, so it's been a long time since I was a spring chicken. I did the first estate plan that I was ever a part of doing back in 1981. I did the first of the kinds of trusts that Scott was describing in 1993. I didn't invent them, but the first one that I had any part of. So I've been doing pretty high-end financial work, tax planning work for the principal owners of privately held companies and real estate and financial asset investors for about 40 years. And I guess I was trying to get Ruth to ask that question. And remember, Barry, you have 3 minutes, so. Okay. Oh, I don't need 3 minutes. So in any event, the only point that I was trying to get across was to make sure that you understand that for a lot of our clients, the final solution is not either a 1031 or an MIS or a trust. For a lot of people, as we dive into their objectives, we might, for example, find out that they really do need some cash from a sale for one purpose or another, business purposes, investment purposes, et cetera, but some things that they want to do that don't involve real estate, but they're not totally soured on the real estate business. So we might end up deferring the taxes on the sale of a particular asset using both an MIS transaction and a 1031 at the same time. We might, for asset protection purposes, have transferred the assets into one of the trusts that Scott was describing up front. That trust is classified in the Internal Revenue Code as what's called a non-grantor trust. It's a technical term. It just means that the initial trustee and the beneficiaries are not the same as the person who set the trust up in simplest form, simplest English. But because it is classified as a non-grantor trust, it can be its own taxpayer. And as its own taxpayer, it can be the owner of these properties, and it can elect to participate in 1031 exchanges or monetized installment sales, or it can be the investor in the Delaware Statutory Trust, those kinds of things. It was just a matter of making sure that you understand that these aren't exclusive remedies to a significant capital gains tax problem. Frankly, for a lot of our clients, we end up using a combination of all three of these at the same time. Right. That's why we're saying that it depends on each person. What do you have? What do you need? Let's help get you there. So we did have a question come in. Can you use the monetized monetary investment trust to defer Bitcoin profits to purchase investment real estate? So,
well, let's start with Anita, because when she did the monetary, then does monetized installment sale work with cryptocurrency from your perspective?
I've not looked into that. Off the top of my head, I was like, as long as it is a transaction, and not just you're cashing out Bitcoin, it potentially could be, it potentially could work, but that is a very specific question regarding, when you say that Bitcoin profits, are you talking about that you purchased Bitcoin and now you want to sell them? And that would take, that's a very simple question. The answer is very complex. So,
Peter,
Peter.
looks like he's good.
Raise my hand. So if you have any sort of taxable gain that you're reporting to the IRS, you can invest in a qualified opportunity zone. So any taxable gain, and just the gain can be invested. It doesn't have to be real estate. As far as I know, and I haven't, again, to follow Anita, I haven't looked into the specifics of Bitcoin, but if you're reporting a taxable gain to the IRS, I would look at a qualified opportunity zone to defer those taxes. And
All right.
that is something that I offer as well.
And I'll jump in
I
there.
was gonna
So
say the one place I know it does work is the opportunity zones.
Okay,
so
Scott.
I'll jump in there and answer that. So you sell the cryptocurrency using the monetized installment sale because it's still reported as a property sale, not securities, except for the whole XRP lawsuit going on because they're a little bit different, but it's still reported as in terms of capital gains. So you can put the cryptocurrency into the monetized installment sale, and we've already vetted that out. And then the funds from the monetized installment sale, proper use would be to buy investment real estate. So that would be the tracking. Remember, Barry was talking about multiple ways to do that. So use the monetized installment sale, then use the funds from that to buy the real estate.
Right.
I can add just one thought really quickly to that. If you wrap all of that Scott was just talking about inside one of the Dynasty Spendthrift Trusts he was talking about, then you can wrap it all inside bulletproof asset protection, remembering that first rule of tax planning that Ruth referenced before, which is don't lose your assets.
Don't lose your assets. Yeah, yes. And Anita, Mike Bishop is on several Bitcoin boards, and he's excited to do them. So we'll really have to take a look at them because I think a lot's going to be coming up for you there. All right, the next question that's in the chat box is for Peter. Many businesses opt to incorporate their businesses in the Delaware due to the tax benefits. How does this relate to the DST that you work with? You got to unmute yourself, Peter.
I know how to do that.
Thank you.
So Delaware is a very tax-friendly state. That's why many businesses operate there. In fact, the history goes back to when our country was being founded, and many businesses were being incorporated in New York City or New York State. Delaware said, we want in on this. So they made very friendly tax laws and made it inexpensive to incorporate. That's the basics of it. It's just easy to incorporate businesses in Delaware. There's no secret sauce outside of that.
Thank you, Peter. So there hasn't been any questions that came in, but to that question, Michael, what would you tell somebody coming out of a 1031 as an individual and wanting to create a corporation to buy a DST? Would that work? Or Katie, I'm not sure, either one of you. So basically what I'm saying is, if an individual, say myself, Ruth Benjamin, sells an investment property, and then I go to Peter and I want to create a corporation to buy into Peter's DST, does that work?
I can answer this. So in a 1031 exchange, what we refer to as vesting has to remain the same throughout the entire exchange. So the manner in which you are selling has to be the manner in which you are purchasing. The only way this is can really work, so if you're selling as an individual, you do have to buy as an individual. If a husband and wife are selling, a husband and wife have to purchase. If a corporation is selling, corporation has to purchase. There are some additional mechanisms in which partnerships will drop and swap members. Those can get very complicated, and if anybody has any particular questions about that, we can talk offline. The only difference in this, and the only caveat, is in single member LLCs. So if I'm Katie Petty and I'm selling a property and I want to, open Katie Petty LLC, I can do that. And so that's the only caveat. But typically, to keep things safe, the IRS wants to see that essentially the taxpayer remains the same throughout the transaction.
Right. And people will ask, how will the IRS know? Well, if you file it, as Katie said, her LLC has a different tax ID number now, right? So if you sell as an individual under your social security number, but now you're reporting the property under a different entity, you might have a problem. That's where Anita comes in. Okay, you guys, use Anita to help you walk through these transactions. Peter, you have something?
Well, I don't know if that was a trick question, but we have worked on quite a number of custom transactions where the DST sponsor is actually buying a piece of real estate from an individual. The sponsor then takes that real estate, creates a DST. The individual they bought it from is doing a 1031 exchange back into their own property through the DST structure. And then the sponsor is also raising money from other investors. So it's a way for an individual to stay in their own real estate, but get out of that day-to-day management and be involved in a Delaware Statutory Trust. Custom transaction.
Anita, you need that one because I would be going red flags.
No. I have no problems with what he said, but I just wanted, since we're talking about entities, if you are owning property, and I'm talking specifically real property, and you are looking at, should I hold it as a corporation or should I hold it as an LLC? If you take nothing else away from this at all, and we're all talking because it's tax strategies over your head, just remember this. Unless you have some tax advice, there are specific consequences when you hold real property as a corporation, especially if you want to distribute it out to the shareholders of that corporation that exist in a corporation, but they don't necessarily exist in an LLC. So it's much more advantageous for transferring out of the entity into your individual names under an LLC versus doing it as a corporation. So before you put real property in a corporation with whatever strategy, or you're just trying to get some asset protection, don't go put it in a corporation until you talk to somebody. I don't care if it's a tax professional, CPA, tax attorney, somebody who is knowledgeable in it, because I've seen a lot of people put it into a corporation. They want to distribute it out and they are shocked at the tax consequences.
The principal consequence that Anita's talking about there is called massive pain.
Yes, that's for sure. When you have to write those large checks, especially here in California, the tax bill is ridiculous. So, when you even start to think about selling properties, or you want to think about how to protect your assets, reach out to these people, get your plan, do your homework. And that's where, Scott and I can help guide you to where you need to go for further assistance. Either Anita, Michael for 1031s, Peter definitely for Delaware Statutory Trusts. But usually talking to people, we can figure out about where they need to be. So we're here to help out. It looks like we still have another 10 minutes. If anybody wants, is there anything that you think they should know, the agents should know when talking to their clients that we haven't brought up today?
I'll give you one quickly based on work we did for a client about a month ago. And it's consistent with maybe one of the conclusions I've come to after 40 years of doing this. And that is, don't guess at this stuff. We literally took a transaction where a client was selling a single property. He had only recently acquired it in the last 2 years. He had a little over $1.1 million of gain in the property. And he was trying to figure out what approach to take to handle that capital gains liability. And in the end, we put it all in spreadsheets for him. We put it all into the literal tax forms that would get filed. The tax consequences between federal capital gains, the unrecaptured depreciation that gets taxed at 25%, the net investment income tax, all of those things, by putting the numbers on the forms themselves, I could show him that his costs, whether you define cost as literally an expense that you're paying or tax, it's all costs, it just has different labels on it. But his costs ranged from a high of $455,000 to a low of about $150,000. And the final solution that got him to that $150,000 cost was a combination of MIS, 1031, and use of the trust. It was not an all or nothing. And there were literally $300,000 worth of differences in the costs by using that combined approach. And it was very easy to see when you're looking at it on spreadsheets and tax forms. Don't guess at it.
Yeah, and you know, the information that's given to you is free advice. I mean, not Anita, of course, because she's the attorney, but any one of us are willing to talk about your transaction to figure out the best way to go. And of course, we're going to always ask you to get your own tax advice. And as I've said a million times, Anita's a great person for that before you get into something and then wish you did not get into it. So, you know, Barry, like he was talking about a client that used up hours, a good, what, at least 40, 50 hours of advice before he
I don't think it was any more than 38.
It was crazy. So yeah, we're out there to help out. So okay, does anybody else? I see Jonathan's back on. Are we getting close? Yep, we are getting close to the end. So if anybody has any questions, try to get them in here. I see that everybody has put their information in the chat box. So Scott, do you want to say anything?
Hi, I'm good. I've got a lot of things I could say. I was just thinking about Peter, thinking, you know, Peter talked about being able to call him on the last day. With Delaware Statutory Trusts, go into 1031 with that as an option, as one of the replacements, not just as the backup, but, you know, really investigate that as an option, because a Delaware Statutory Trust is a great way for passive income and to get rid of those tenants, toilets, trash, all that stuff, you know. So but that's what I was just thinking about is, you know, be proactive and don't just use Peter as the emergency backup, but look at that, do the investigation for, you know, help your clients to know that that's an option so that they can look at the single family residence versus multifamily versus what the DST has to offer in advance of making a decision on the replacement.
Yeah, I think the biggest thing that we find when we're talking to clients is what's their personality. Some of them, you know, like Peter said, some of them don't want to lose control. Some of them don't want to own real estate. Some of them, you know, everybody's different. So that's why, you know, there's not one answer for your client. So just reach out to us and we will help you. So Jonathan, I'm going to turn the meeting back over to you.
Wonderful. Thank you, Ruth. And thank you, everybody, for coming on today. Incredible information. I would definitely recommend to anybody out there who's on to capture the information for these people. Some of us are part of SCORE, so you can download the app. You can find us that way, which is a great way if you have questions later on. You forgot to grab the information today. You can definitely find us that way. We can connect you with these local and not so local professionals. Thanks again, everybody. And a few things. Jody, do we have Jody back on?
Yeah, somebody asked if they can get a copy of the recording. And Jody, I think you put it on within a certain amount of time on the SCORE website. Is that right?
It'll be up next week on the SCORE website.
Okay.
Yeah. Beautiful. And a few just reminders of things coming up. We have a member appreciation day at the SCORE headquarters next week. It's going to be April 22nd. So on Earth Day, there's going to be food trucks there, sliders. I will be there. Looking forward to seeing everybody in the flesh as opposed to Zoom all day long. And then again, we have on May 13th, we've got Scott Anderson from Bank of the West. He is our world-renowned economist going to be speaking via a webinar via SCORE. So definitely not time wasted there. Really interesting stuff that he always has to say. So I'll be looking forward to that. We also have our next Brunch and Learn coming up on May 21st of next month.